Get Rich Slow with John Wolf. Hey, first I want you to like and subscribe to my channel. Then I'm going to tell you the basics of the different kinds of home loans. So there are basically three kinds of home loans out there. You have your government insured, government regulated, and then you have portfolio. Now, portfolio loans are taking kind of a hiatus because they're a lot higher risk for the lenders. So there's not much or any of that happening right that second, but I'm sure they're going to be back in the next few months. So we're primarily going to talk about government insured and government regulated. And most people haven't heard them this way, but your government insured loans is your USDA, your FHA, and your VA home loans. And the government regulated, we normally just call those conventional. So let's talk about why you'd want to do any one of them just in brief right now here. So USDA loans. USDA loans are great if you qualify. The qualification window is very narrow, and those homes have to be well outside of a metro area. The USDA has a map. You can look at it online. And it's probably the most difficult loan to just get all of the paperwork done. Not that it can't be done. I do plenty of them. The next one is FHA. And FHA is a loan for people who have some credit challenges, aren't in the far countryside like USDA, but you do have to put money down. The minimum down payment for a normal FHA is 3.5%. But then again, I do the zero down program in Washington, which is zero down, and it's not necessarily a higher interest rate. In fact, sometimes it's a lower interest rate to go zero down than it is to even put the money down, which is crazy. But, government programs, so love them, use them. And the last one is VA. Now, VA is for veterans who have honorably served our military or their spouses under the correct circumstances. There's even a few people who served in other militaries who are available and able to do VA loans. But anyways, that loan is zero down, and it has absolutely the lowest guideline standards for credit score, lets you have the highest debt to income ratio, is zero down. It has zero mortgage insurance. And we'll talk about mortgage insurance in another video, but that is a great selling point. Now, what's not great about it is it actually has the highest upfront fee if you're not a disabled veteran compared to USDA or VA. Now, the next one that we were talking about is the government regulated, and we call those conventionals. There's two bodies that do the insuring for that, and they are Fannie Mae and Freddie Mac. And the basics of that are 3% down minimum, 5% down if you're not a first-time home buyer, and they are the most sensitive for pricing and approval towards credit score. So basically for all of those government insured loans, once you have a 620 credit score for a government insured loan, you're good to go. You can go much lower. The minimum for FHA is 550. But for a conventional, the absolute minimum is 620, and you're not really playing the game until 680, and the loan gets much, much better up at 700, 720. However, the positive end maxes out at 760. I know there's a lot of people trying to get an 800 credit score. It doesn't pay you in any way to have a higher credit score than 760. So once you're there or once you're close, no sweat, you've made it. But anyways, that's also the only loan that has variable mortgage insurance. So VA, it's a flat fee up front. USDA, it's a flat fee up front and a monthly. FHA, it's a flat fee up front and a monthly. And then on a conventional, you can choose to do a flat fee up front. Almost never makes sense to do so. And there is monthly mortgage insurance if you're putting less than 20% down. Now, a lot of people are shocked at how little it is, but that depends a ton on what your lender is. I know I just did a quote for somebody yesterday, and they got their mortgage in December when interest rates were higher. So I just quoted them a refi. The interest rate is lower now. It was probably lower with my company then. Not that that's really important. But the interesting thing is the mortgage insurance for the same credit score, for the same amount down, because it's still just 5% down, our mortgage insurance is much less. And that's because my company is fully delegated. That's because my company does such a high volume. It's because we hold our own loans. So my company has a higher rating among the mortgage insurance providers. So that, along with credit score and the company you choose, makes a huge factor. How huge? Well, on a $425,000-ish loan with great credit and only 5% down, some lenders will be having you pay upwards of $160. The same quote for me was $80-something a month. And that's a month for the first 10 plus years. So that's a lot of money. So anyways, if you have any more questions, please put them in the comments. Smash that like button. Have an awesome day. Bye.